Welcome to this day-to-day basic bookkeeping presentation. We're going to be going through some of the core accounting concepts that Xero uses on a day-to-day basis to get your balances in the right places and your reports out of the door. I'm Ashley and I'm part of the education team here at Xero, and I'm going to be taking you through all the different elements so you can really start to get to grips with all of your figures and take a look at how your accounts are physically created. The first thing we're going to be taking a look at today is the basic accounting concept. Now within this contains 5 different categories of accounts. Now Xero uses this in order to build up your chart of account structure. Once the balances then are posted to these accounts, this is how your net profit or your net loss starts to be calculated. Moving on from that, double entry bookkeeping is automatic throughout Xero, but it's really handy to actually know how this process works. Also great if you ever need to correct anything, because you have that basic concept of where one entry will be sitting if the transaction needs to be changed. Banking within accounting is one of the hardest things to grasp. Everything is reversed. Once you understand banking within accounting, you'll be able to see the bigger picture a lot clearer. We'll then move and take a look at bank feeds, how you can set that up within Xero, the 2 types of feeds that are available, so you can start getting your bank statement lines imported straight away and use that to proactively create your accounts. The chart of account structure is really important for you to understand where your balances sit and how your profit and loss is calculated. So we'll look at that in detail, and it's also great to have an understanding of the account types that can be set up within Xero. That will determine where that physical balance will sit in your reports. Now last but not least, year end is all automatic and it works off your financial year end date that has been entered. But we'll look at the process, we'll look at where your net profit and loss will ultimately sit in order to start building up your equity and your capital. Essentially, your accounts are created by taking a look at all of your purchases or anything that you're buying, taking that away from anything that you're selling, and that results in whether you are making that profit or your loss. So really how well your company is doing. You do have some other elements in here, such as inventory items and work in progress, but essentially buy less sell equals your profit. Let's move on and take a look at the categories of accounts. This will help you start to understand how your accounts are physically compiled. Now what we're going to do throughout each of these categories is go and take a look directly in Xero so you can see which type of accounts sit under these different categories. Now the assets are essentially anything that your business owns that really isn't transferred into cash within the short term. So anything that your business physically owns which helps it complete its objective or its goal on a day-to-day basis. But in addition to that, you also have current and non-current assets. Now, the best way to understand the difference between current and non-current assets is your current assets balance will change over a shorter period of time. So, for example, your bank balance or your accounts receivable, essentially your customers that owe you money. Over a short period of time, that balance will fluctuate, but it is still regarded as an asset. Now, your non-current assets, those are the balances that remain fixed over a longer period. So, for example, your motor vehicles will be a non-current asset. You don't tend to buy them unless you're in the motor vehicle industry on a regular basis, maybe once every 3 years or a couple of times a year. So your fixed assets are your non-current, and your current assets are those that tend to fluctuate over a period of time. Let's go and take a look in Xero, and what we want to go and do is we want to go to settings and chart of accounts. You'll notice it's very easy to navigate within the chart of accounts structure. So let's go and take a look at the assets section, and we can see here we've got things like bank accounts, the accounts receivable as I just mentioned. You've got then all of your fixed assets if we scroll down a little bit further. And there are lots and lots of different chart of accounts that appear within this asset section, but this just gives you an idea of those assets that are available. Next, we have our liabilities. Now, your liabilities are essentially anything that your business owes, usually in the form of money. But it's important to remember the difference between an expense and a liability. An expense is usually something that is owed within a short period of time, if not immediately. So, for example, taking your team out for lunch. You pay that bill there and then. Therefore, it is regarded as an expense. However, if you buy something on credit, then that will be considered as a liability because you aren't paying for it there and then. You also have current and non-current liabilities, just like the assets, and the same theme runs within these. Your accounts payable will be a current asset because the balance of that will fluctuate over a shorter period. A loan from the bank, however, would be considered as a non-current liability because the balance of that is likely to remain within your business over a much longer period. Again, let's jump back into Xero and take a look under the liabilities section, and we can see within here you've got things like accounts payable, your unpaid expense claims, accruals, income in advance, VAT, national insurance, and things like that. Essentially, it's anything that your business owes but isn't being paid immediately. Next up on the list, we have the capital or equity. We do have some chart of account codes within Xero for this particular category. However, in order to understand how this particular category is calculated, we need to take a look at what we call the accounting equation. So this is essentially taking a look at your assets minus your liabilities, which equals your overall capital or equity. And this is essentially what your business is really worth. It's all about keeping the assets and the liabilities balanced. You can, in fact, have two different scenarios. So you can have a business which doesn't have much cash in the bank, so can't physically pay their debts in the short term, but actually the business may be worth quite a lot, so their equity is very healthy. You can have the complete opposite to that as well, so you can have a very healthy bank balance, but the business is actually in negative equity, so their loans outweigh their assets. It's all about keeping the balance. Have a healthy cash balance and a healthy equity, and it's happy days. So let's go and take a look under the equity section. We've got a few different chart of accounts that are available within here. So those capital ordinary shares, if you deal with shares within your business, you've got the owner's funds introduced. So that's where the initial injection of capital will be coded to. You also have owner's A drawings. Now, owner's A drawings is in fact a negative equity or negative capital account. If the business owner wants to draw direct funds out of the business, that's where their withdrawal will be coded to. Essentially, if the business owner is taking direct cash out of the business, it is coming straight off the equity or capital, thus reducing what the physical business is worth. You also notice on this list we have the retained earnings account. Now, this particular account is used within year end, and we're going to go and take a look at that right at the end of this presentation. Next up, we have the income or revenue. This is what keeps your business running on a day-to-day basis, the bread and butter, what you receive on a regular basis, usually for work or investments. Now, investments is an interesting concept because you can also have indirect income. Say, for example, if you give an employee or another business a loan, if you charge interest on that loan, that can be an indirect revenue stream. But let's go and take a look within Xero, and we'll go and take a look at the examples that we have within here. So we can go under the revenue section, and you can see here that we've got the sales, other revenue, and interest income. Now, other revenue might include things like rent, if you have any property that the business owns and you rent that out. But you can also have other forms of indirect revenue. For example, discounts can be considered as an indirect form of income. You're essentially getting money off the list price that was quoted. However, let's go and take a look at the last category, which is the expenses. Now, just like life itself, this is the most popular type of category within accounting. And we can go and have a look within Xero. As you can see, lots and lots of different expenses. So purchases being the most popular one, and you'll notice that that sits under the direct costs. When we look at that chart of account structure a little bit later, you'll be able to see how the different account types place the balances in different areas within your reports. But you've got the obvious ones like advertising and marketing, bank fees, cleaning, consulting, lots and lots of different ones that are available within the standard chart of account structure. Now that we've taken a look at the 5 different categories, we can put them all together. It's always great to remember things in real life examples. So if you remember ALKI, you've got assets, liability, capital, income, and an expense. These are positioned in a particular way for a good reason. You'll notice on the end we have the assets and the expenses. Now these are what we call debit accounts, and all will become clear when we look at the double entry process in a little bit more detail. Now liability, capital, and income are all credit accounts. Essentially what that means is if I want to increase an asset or an expense account, I will physically debit that account, whereas a liability, capital, or income accounts, I will credit it. They are also positioned in this way for another reason. You will notice the assets, liability, and capital accounts all sit on your balance sheet, and the income and the expenses are all about your profit and loss. Essentially, the profit and loss and balance sheet do actually speak to each other, because at year end, when Xero calculates all of your expenses against your income, you are then resulted in that net profit or loss, which then automatically attributes onto your capital or your equity accounts. Let's go and take a look for 1 second about how bank accounts work within your accounting. The best thing to remember about bank accounts in accounting is whatever you think in real life, think the opposite. So for example, when you receive money in your bank account, say for example your wages, that means your bank account in real life will credit. You have to turn that on its head within accounting. Any money that was received within your accounts, effectively by double entry, your bank account will be debited. When you spend money, it will be credited. Now what that allows us to do is it allows us to record the physical entry within the account that particular transaction relates to. Let's go and look at the T accounts, which will help explain this clearer. You can see here we've got the bank account and the sales. Now essentially the T accounts that you can see on your screen are split down the middle. Any entries to the left hand side are debits within that account. Any on the right hand side are credits. The key thing to remember about double entry is that the debits always equal the credits, and you always do 2 entries per transaction. So in this example, I've received £500 for one of my customers. Now in real life I would credit my bank account, but what I in fact do is I debit it. We then need to go and balance that up and enter a credit somewhere within the accounts. Now because I know that that is relating to a direct cash sale, I can then go and record the same £500 within the credit section. So I can see immediately that £500 has been received and it's automatically gone into my sales. There's a great report within Xero that you can use to go and see how this is automatically done, and this is the journal report. So let's go back within Xero, reports, and you can see the journal report under detailed reports. As you can see here, we've got a nice long list of all of the different journals that Xero has posted, and in every single case you will notice that the debits always equal the credits. So we can see that the first journal, ID 364, is paying one of our suppliers. So you can see that it's dealing with the accounts payable and the bank account. So I'm paying money out of the bank account, as you can see, a credit, and I'm also debiting that accounts payable, effectively settling one of my supplier bills. You'll also notice the next one down. That's a physical supplier bill being entered. I'm crediting that accounts payable account, which is a liability, and I'm also coding the expense, to the travel and the VAT accounts. Now the great thing is that you can see here that all you need to be concerned with is one of the entries. Xero will balance this up automatically for you. Another great report to go and check out how things are doing within your accounts is the trial balance report. This is a report that accountants and bookkeepers use on a regular basis in order to make sure that all of the double entry process is being entered correctly. Now in order to access this report, we can go to the top of the page, go to reports, and we can see the trial balance under detailed reports. If we go and click in here, what Xero does is takes a look at all of those account balances available in order to make sure that the debits equal the credits. And when we get to the bottom of this report, you can see that Xero has calculated just that. Never will you be able to go into Xero and generate a trial balance that doesn't balance. You just deal with the main transaction and Xero will go and make sure that everything matches up. What we're going to go and take a look at next is banking within Xero. Traditionally, if you've been using desktop accounting, you would have been posting your transactions on a day-to-day basis, and then at certain points during the week or during the month, you would have to go and compare that back to your physical bank statements to make sure that you haven't missed anything. Now, Xero allows you to be a lot more proactive because you can directly connect your bank account to Xero and set up that automatic feed. On a day-to-day basis, your previous day's transactions will automatically be brought in. Now, because that's the case, you can use that raw bank statement data to directly reconcile or create your accounts. It's so much more efficient doing it this way because you don't have to go and post those transactions and compare it back. You're just touching the information once. Now, there are a few different types of bank feeds that you can set up within Xero. We have two predominant bank feeds. Those partner feeds, if you don't bank with any of those, you can also set up a Yodlee feed. Now, Yodlee feed does not incur a charge, and Yodlee is in fact a third-party aggregation service, which is completely secure but uses your online banking to obtain the information and bring that over into Xero. Of course, you don't have to set up a bank feed, and you can always import that data via an OFX, QAF, or CSV file. Now, we do recommend that you try to use an OFX or QAF file where possible because you can ordinarily download that from your online banking environment and upload that nice and easily. Of course, if you can't obtain those file types, you can use Excel in order to create your bank statement manually, save it as that CSV file, and then import that in no time at all. In Xero, we support bank, credit card, and PayPal accounts. All of those can be set up and an automatic feed also created for those. We also recommend that you create a dummy bank account for your petty cash within Xero so you can use the great features of the bank reconciliation to keep a much better control of this. Let's move on and let's go and take a look at the chart of account structure within Xero. Now, there's a great place within Xero that you can go and take a look at all of this information that I've got up on this slide. I'll go and show you that in a second. Each one of these account types will determine where that physical account you've created will appear within your reports. As you can see here, there's lots of different account types that are available when structuring your chart of account. It's important to make note of which account types sit under which section within the reporting, because this determines where that balance will end up. For example, if I wanted an expense to come off of my net profit, I would need to make sure that I choose an expense, depreciation, or overheads account type. If I chose, for example, a direct cost, then that will be taken off and used to calculate my gross profit. Let's go and take a look within Xero and I'll show you where you can go and access all this information. We can go back to the chart of accounts settings page and then just click this add account button. As you can see here, to the right hand side, you can see all of the information that was just contained within that slide. So if you do ever need to go and create any new chart of accounts, just make sure that you select the right account type where you want the balance to go. Now, year end within Xero is completely automatic, which saves you so much time calculating all of that net profit and loss, and essentially your equity or capital. Now, the year end date is the key date when calculating the financial year end in Xero, and this is the date that Xero will use to automate this process. Now, Xero automatically uses the balances in order to calculate your overall net profit or loss. Now, what Xero does with this, it automatically attributes it to your retained earnings drawings account, and that will then increase your overall equity over time, providing you don't take any drawings out. So let's jump into Xero. What we're going to go and do is we're going to go and take a look at the movement in equity report. Now, in order to get there, we need to go to Reports, or Reports, and you'll notice the movement in equity report under the position section. Now, I know that this particular demo company has been set up for a year-end date of the 31st of March. So we can see that net surplus after tax calculated already, which has been brought over from the profit and loss for our year-end. Watch what happens if I go and change this to April 2014. We can see that the net surplus after tax has automatically been moved up to our opening balance, and for the month of April so far we've got a net profit of $350.96. So you can see that Xero will continue to build this up throughout the year, and when you get to your year end, you've got that real-time balance of physically what your equity is at the end of that period. Thank you for taking the time out of your day to join me. Hopefully you've picked up a few things that you can put to good use straight away and start to understand how your business is performing and those balances a lot clearer.